Okay, hi everyone. This is going to be the first lecture on the state and local tax chapter, right? So we're talking about SALT here, and SALT is typically like a practice group if you go to a like medium to large size public accounting firm. Normally, what they do is they're the spin-off of like the C Corp group in the sense that the Biz Corp, like the people who do like the Cs and the partnerships, they'll do the Fed return, right? Like the Fed, the 1120, the 1065. And then the SALT group will handle the state returns and then state and local like income tax planning, right? Like a SALT group may do something like a nexus study, right? So obviously, the purpose of state and local tax, each state is its own sort of sovereign entity. They have their own state tax laws, sort of same process with like a legislator, judicial and administrative, functions there. In this chapter, really what we're looking at, if I get the little draw function here, right, we're looking at state sales tax, use tax, and then income tax. And most of it is going to be focused on income tax. So we're going to kind of briefly touch sales and use tax and then go to income tax. The starting point here, right, if you ever talk about SALT, is nexus, right? What does nexus mean? It really, you can think of it like a connection. What it's saying is anytime you have nexus in the law, it's really saying the court has power over you and it's reasonable to hail you into court, right? So if you just got a letter in the mail that says, hey, we're bringing you into court for California, and you never stepped foot in California, you had no connection there, you would say, this is crazy, right? There's no nexus, right? There needs to be some kind of connection to make it reasonable for a government to impose a law on you, to impose a tax on you, to bring you into court in the state. Right now, when we're talking about nexus for tax laws, right? So if a government wants to impose a state government a tax on you for like your earnings or on your sales, there has to be nexus, and nexus is determined at each level. So there's like nexus for sales tax, nexus for use tax, nexus for income tax. So there's like a separate standard for each of those. All of those standards are really a reasonable standard, a foreseeableness standard. There's some type of connection you have with the state that makes it reasonable for them to impose a tax on you. Now, how do you establish nexus as a business, right? It can be where you're domiciled, right? Like where your business, if you're a C Corp, you filed your articles of incorporation in Delaware. Hey, I have a commercial domicile in Delaware. I have nexus with Delaware. That's, an easy way. The more common way is if you have sufficient minimum contacts. In other words, this is just some type of connection that makes it reasonable. Maybe you're selling goods, you're providing services, you have employees, property, or payroll in that state, right? There's a connection there, right? So you can see there's different things that create and don't create nexus. It is kind of a facts and circumstances test for certain types of activity, right? So like maybe like one sale that's for $1 probably wouldn't create nexus. But if you had hundreds of sales, or you had one sale that was for $10 million, right? That would. So there's certain things that automatically create nexus, and then other times it's kind of a gray area. You have to look to the level of activity. So here, right, things that create nexus, you can see if you have significant sales, if you have a branch office, things that do not create nexus, right? If you just deposit money into a bank purely, and things that may create nexus, right? It depends, if you have, employees, where they reside, right? So one of the things here, nexus depends on where employees perform the services, not necessarily where they reside, right? So if you're looking for nexus for that, you got to say, hey, where are they performing the services, right? So we have an example here. Red Corporation engages in the following activities, right? They sell $1 million in state A, they maintain a branch in state B, they deposit $1,000 into state C bank, and then they hire a state D resident who works in state A, right? where do they have income tax nexus, right? So this is just showing nexus here. State A, yes, right? Commercial domicile. State B, yes, they have a branch office. State C, no, right? Putting money just into a bank account by itself is not going to rise to the level of nexus. And then state D, right? Well, it would be no, right? Even though that resident is from state D, we don't look to see for nexus purposes where they reside. Rather, we look to see where they work in state A, right? So the answer there for state D would be no. So let's kind of talk about these three taxes, right? In this chapter, we're gonna, talk a little bit about sales tax, a little bit about use tax, and then income tax. So let's start here with sales tax, and it's kind of a partner with use tax because if they don't get you on sales tax, they'll likely get you on use tax. So general rule, right? Sales tax is posed on the sale of tangible personal property, right? You go to the store, you check out, it's $1, you're going to pay $1.07, right? That's 7 cents is sales tax. The business, right? They collect that 7 cents. And then periodically, once they build up that kind of reserve, they send it off to the state and local government who collects the sales tax. There are some exceptions, right, for sales tax, and a lot of this is state specific, so I'm kind of giving you just like the themes here. One of the big things is like food and real property, right? If you go to the grocery store and you just buy like fruit or something, right, or like milk, generally states aren't going to tax food. Likewise, if you buy a house, right, when you go to buy your first house, they don't charge you sales tax on that. But generally everything else, right, they're going to charge sales tax on, right? One thing that's like big sales tax that adds up is when you buy a car, right? Right, you sell a car, the person who's buying it, right? The sort of the dealership, or if you go to the notary, they handle that kind of sales tax aspect of it. But, be aware, general rule is tangible personal property, you're going to get hit with sales tax. You can read through this. This is kind of like an interesting case from New York. How do you draw the line with food versus candy? The question then becomes, right, so once upon a time, and this is maybe like 10, 15 years ago, if you would buy stuff on Amazon or eBay, it would kind of be this like odd situation that like sometimes they would charge you a sales tax and sometimes they wouldn't charge you a sales tax. And the reason for it would depend on like the actual like seller itself, where they're located, and if they had nexus. Different states had different rules, and there wasn't kind of a collective decision on this yet, right? So if we're just talking about high level here, right? If a business, right, a seller, for example, or a business has sales tax nexus, they then have to collect and pay sales tax with the state, right? So, hey, we're in state A, we go to a store in state A, we buy some goods. Hey, the business has nexus, sales tax nexus with state A through that, that physical building, that office. They have to collect sales tax whenever I check out, right? That's the setup there. They could be incorporated in state B, right? A different state. It doesn't mean all of their activity is in state A, right? Maybe their main business is in state B, but hey, if they have a store here in state A, that's going to create nexus. They're going to have to withhold sales tax. If they do not have sales tax nexus with a state, then they don't have to collect and pay sales tax. And normally what happens here is the buyer, right, is going to have to pay likely a use tax in that case. So we'll talk about, sales tax versus use tax, but general rule, right? If you need to, if there's going to be sales tax, there needs to be sales tax nexus. Right, so historically, nexus was established through a physical presence standard, right? This is still good, right? In other words, you can still establish nexus through physical presence. It's kind of like one route, there you go. You can get it through physical presence. In the Wayfair case, right? So Wayfair, that kind of online business that sells furniture and whatnot, they basically said, hey, in addition to this physical presence standard, we also are going to allow for something called economic nexus, right? So you can get it through physical and you can get it through economic, right? We'll talk about what economic nexus means, but just as a starting point, right, what people were doing was they were making sales online, right? Maybe we're in state X and we're making sales in state Y, and we said, hey, we just do everything over the internet. We have no physical connection. We have no nexus, right? That's a very simple, high-level example. But what was going on is internet sales were effectively having people not be subject to sales tax. There were arguments being made for that. So Supreme Court came in and said, hey, you can get physical nexus and economic nexus. And in this framework, right, states can impose sales tax based on economic nexus, basically as long as there is no undue burden, right? You can look and see what that, those ideas there are, but the general rule is going to be sales tax is going to be allowed for economic nexus. General rule is going to be sales tax. The exception, right, is going to be a safe harbor. And it basically says this, right? Here we are in, let's just say we're a California business, right? And we're, doing business or sending stuff to, let's just say Ohio, right? If we have less than, right, 100K in sales, or we have less than 200 total sales, we're not going to be subject to economic nexus. It hasn't risen to the level yet to be economic nexus. So if we look at 23.1 here, right, they give us some facts. A business domiciled in another state sends promotional brochures to Arizona and Colorado. Right, from those brochures they send, it looks like they have 89,000 in sales based on 215 sales in Arizona, 75K in sales based on 163 sales in Colorado. Do they have economic nexus with Arizona and Colorado? Well, yes, general rule for Arizona, they're above 200 sales transactions. No, in Colorado, because they're below 100K. Right, so in the first one for Arizona, right, that was that guy. They were above 200 sales, so the exception does not apply. For the second one, Colorado, they were below 100K, so the exception does apply. They then change those facts if you look at that example, right? Like if you were looking at that state right there, what was that, Colorado, right? They then say, hey, if you send a sales rep in there, does that create nexus? Well, yeah, it does, because even though you have less than 100K in sales, right, you don't have nexus from the economic standard, but then you have physical presence standard. So it's not like, it's just another door that gets you in there. So we said here, if there is no sales tax nexus, what normally happens then is that the buyer is responsible for paying a use tax on that. So what's going on here? A lot of times, right, there will be states that have sales tax holidays, right? So say that you're in West Virginia, right, and Pennsylvania up here, right? Let's just say once a year on the weekend, right, they have a sales tax holiday, which basically the government says, hey, on this weekend, to help local businesses and encourage commerce, we're not going to charge any sales tax on sales, right? So you go up here, right, and maybe you buy a washing machine and a dryer, right? Let's just say you spend $1,000 on this, and then you bring that down into West Virginia and you use that washer and dryer here. Well, what happens is, right, you had a 0% sales tax that you paid up there, but let's just say West Virginia had a 7% sales tax had you bought that in West Virginia. What will end up happening is you're going to owe a use tax, for using this property you bought out of state for effectively the 7%. It normally matches whatever the amount there was. Say that you went up to Pennsylvania, right, and it wasn't the sales tax holiday, but just say, hey, they have a 3% normal sales tax. They don't, but let's just say for the sake of this example, if you go up and you buy it, you pay 3%, you bring it back, you're going to get hit for a use tax for 4%, right, to get you to that 7%. What's the upshot of this? States see people doing this, right? And they're like, look, we don't want to miss out on our revenue and encourage you to go to other places to buy stuff. They're not collecting, appropriate West Virginia sales tax on it because they don't have nexus with West Virginia. But we want to make sure, if nothing else, we get what we should have, kind of true us up to where we would have been had you bought it here, right? So if we look at 23.2, right, here's some examples, right? There's no economic nexus there. In that one, it says in the same facts, does the customer have to pay? In Colorado there, right? Well, the idea here is, the customer is responsible for a use tax, right? So if they were to come into a state and sell something, right, and they didn't withhold any sales tax, then the customer would have to pay use tax on that. So say, just to kind of give a modified example here, instead of you going up to Pennsylvania, let's just say a Pennsylvania business mailed something to you. And let's just say, for the sake of this example, they didn't collect any West Virginia sales tax because they don't have income tax nexus with West Virginia. Well, what you would then, you'd still have that use tax, right? So if you don't physically travel there, you just buy it online and you use it, you don't pay any West Virginia sales tax, you got to pay use tax. That's what's going on here. They're showing like a simple example of that, right? So maybe they got it in Idaho where they paid 6%, but Colorado was, has an 8% use tax. Hey, they're going to owe the marginal difference there at their home level. Just kind of showing this setup here with the 3 and 4%. So one of the things here is this creates a headache, right? You can see that, hey, businesses, they don't operate just in one state. So they're going to have, now nexus with all these different states. They're going to have to withhold sales tax. It becomes a compliance burden, a lot of paperwork, a lot of headache. All right, so that was kind of like high level sales and use tax. Let's start talking about income tax, right? A lot of it's going to be business income tax, but we'll talk a little bit about individual as well. Right, so most states are going to charge income tax, right? Interestingly, right, not all states do. So Florida, for example, right, if you know LeBron James, right, he went from Cleveland to Miami, right? One of the things here is, if you're going to get, I don't know what he makes, but right, let's just say you're an athlete and you get 10 million a year. Would you rather get that 10 million a year, where in Cleveland they have income tax of, let's just say 4%, Miami, they have income tax, state income tax of 0%, or California, where it's 10%, right? You can see, right, this favors, at least from, an athletic standpoint, people want to play in like Florida and Texas and things like that, where there is no state income tax. So, what will happen is, right, somebody like California, they'll do something like, look, instead of giving you 10 million, I don't know the exact math on it, but it's something like, look, we'll give you 11 million. So we'll effectively put you in the same spot as if you got 10 million in a 0% state on there. So this is called kind of grossing it up, putting you, in light of the taxes you're going to pay, in the same position you would be over here. So the idea here, if we're going to kind of flip a little bit, the businesses, right, they have to pay income tax where they are commercially domiciled. That makes sense, right? Hey, here's our principal place of business. Where we're incorporated, we have income tax nexus there. And again, previously we thought there was just a physical presence standard, but now we're moving again towards that economic income tax nexus standard for it. And again, so both paths are still available, physical and economic. A couple things here, right? In this complete auto transit case, the Supreme Court provided criteria for when states can tax non-domiciliary businesses. So what does this mean, right? So we'll just do California, right? Let's just say we have a California business, and then you have Pennsylvania here, right? If you have the business over here, right, like the C Corp or whatever, they're domiciled in California. From Pennsylvania's point of view, they are considered a non-domiciliary business, which basically means, hey, they're not domiciled. They don't have their principal place of business in Pennsylvania. It's in California. But if we meet certain criteria, right, we can tax Pennsylvania that business, right? And that's what this complete auto transit case says, right? If there is economic income tax nexus or physical presence, right? We'll talk about those, right? There's income tax nexus. That's the big thing, right? In order for Pennsylvania to tax that, there has to be nexus. You don't get to tax Pennsylvania all of their income from like every single sale they have everywhere in the world, right? We're going to let the businesses apportion their income, right? What percentage of our sales were in Pennsylvania? You can tax that percentage, right? We'll talk about apportionment and allocation. Pennsylvania can't discriminate, right? It has to be fairly related to their kind of connection there to Pennsylvania. Kind of continuing here with income tax, right? So we've talked about the general rule is going to be that businesses pay income tax to where they have nexus, whether that's physical or economic. The exception for this is this thing called Public Law 86-272. It's just the federal law. That's the the numbering on it. And PL 86-272 basically says this: even if you have nexus with a state, right? Hey, you, the California business, you have nexus in Pennsylvania. Even if you do that, if basically all you're doing is sending physical goods into the state, you're just shipping them from California and all you're doing is soliciting sales, then we will not charge income tax to you, right? We will not be able to under federal law, under this law, right? So this basically says, hey, stated alternatively, out-of-state businesses are allowed to solicit sales in another state without being subject to income tax, right? So PL 86-272, that federal law, it places limits on the state's power to impose income tax on certain non-domiciliary businesses, specifically businesses that sell only tangible personal property are protected from paying income tax nexus, even if income tax nexus exists, right? So basically, if all you're doing is selling tangible personal property, and on top of this, if you want to, you solicit sales. We'll talk about what solicitation is. You are protected. Now, a couple things is I said only if you're doing these things. If you are providing services, then you're not protected, right? If you provide services and sell tangible property, you don't get protection. You're going to have to pay income tax. If it's real property or intangibles, you're not protected, right? It's only tangible personal property that you're protected from on there. So what's going on here? What's the criteria, right? When are you protected? Right here you are that California business over here. When are you protected or kind of shielded from Pennsylvania taxing you? Well, when that tax they're trying to tax you is based on net income, when all you're doing is selling tangible personal property in the state, when your in-state activities, right, when what you're doing in Pennsylvania is limited to solicitation of sales, right? You're non-domiciliary, you participate in interstate commerce, you approve the orders outside of the state, right? So maybe here you are in California, you deliver the goods from outside the state through a common carrier, right? So we make the sales over here, we ship them into Pennsylvania, right? Of like widgets or something. Now, one of the things here it says, right, we do protect you if you're in Pennsylvania and you're soliciting sales. If that's your only activity, right, you're shipping the goods, you're doing everything over here, but you are soliciting sales, you are still protected. But what does that mean? The solicitation of sales, right? So PL 86272 protects the solicitation of tangible personal property. Basically, if merely all you're doing is soliciting sales in a state, that doesn't give rise to nexus. It has different rules, different meanings, right? What solicitation means, right? That word on it. But as a starting point, right, there is kind of a de minimis threshold, right? If you have one-time sales activity and it's for a relatively small amount, it's probably not going to give rise to, income tax nexus. You can look there sort of at those examples. But what gives rise to protected solicitation, right? In other words, if we are in California, we have that business, all they're doing is sending tangible personal property into Pennsylvania, right? If they solicit in Pennsylvania, these activities are protected, right? These little green check marks. However, if they do these guys, right, any of these, it's not protected. That will give rise to income tax nexus. So what are protected solicitation, right? Advertising. We're in California. We advertise here in Pennsylvania. Providing free samples, maintaining a showroom for 2 weeks or less, owning personal property used in sales activities, checking customer inventory level, communicating with customers, requesting training or evaluating sales representatives, right? All of these things you're protected in doing, right? Feel free to do these in Pennsylvania. We're not going to subject you to income tax. However, if you do these things, these other things, training non-sales reps, making repairs, installing property, maintaining an office, right? Investigating creditworthiness, right? Any of these blue things, sorry, we're going to tax you. Right, so they give us an example here, Blue Corp, right, they're in state A, they engage in the following activities, right, they send a sales rep, they send a sales rep, they send, a sales rep in all of these who does certain things, right, so one provides free samples, right, that's protected on there. And here they communicate customer feedback back to state A, that's protected, right, these are kind of that yellow activity. The other states, right, they're going to be blue over here, right? They're advertising the company's services, right? Services aren't protected. Only, personal, tangible property. They make repairs, right? That's not protected. They accept down payments. That's not protected. So if we go to the book here, right, just to show you some examples, it says a business sends an employee to Oregon to visit retail stores and solicit orders of rafting equipment. Does this create income tax nexus? Well, yes, there's physical nexus by virtue of the sales rep being in Oregon. However, because they're selling personal tangible property, it's protected by Public Law 86272. Right, so this is kind of saying, hey, the general rule is, you have nexus, they tax you, but the exception is 86272. But if they go in and they advertise rafting adventures services, right, that's not going to be protected on there, right? So like selling rafting equipment, personal property versus, hey, come, we'll take you on a boat and, give you a service, not protected. Other situations there, right, basically showing that example we saw. Again, that's kind of the way they're breaking it out on here. So those kind of examples there are all similar to this guy right here. Let's kind of see here. We'll do the next two slides, then we'll kind of pause it on this lecture because we're almost about halfway through here. So a couple things, right, to kind of finish this off. States can assert economic income tax nexus by providing infrastructure, a phone, an internet connection to consumers, right, an economic base that non-resident companies use to solicit business. Economic presence is most often measured through something called the factor presence test, right? Specifically, if a business exceeds any of the following, it is going to have economic income tax nexus with the state. So in other words, right, we have that California business, right? They're doing stuff in, now let's just say West Virginia, right? We know situations, the general rule is they're going to be taxed when there's income tax nexus. We said there's the exception of Public Law 86-272. Under that general rule of income tax nexus, we said you can get it through physical presence or you can get it through economic standards. Now, each state has its own kind of threshold for economic nexus, but one thing that is very common that states use, and again, this is state specific, but this is kind of like a rule of thumb. If this outside business is doing any of the following, it gives rise to economic nexus, right? That California business has more than $50,000 of property in West Virginia. That California business has more than 50,000 of payroll there, right? Employees they pay. That California business has more than 500,000 of sales in West Virginia, right? Or 25% of total. So if you added all of these up, right, it was like $1,000, right? Or $1 million, right? Whatever the case is, if 25% of that total is in West Virginia, there's economic income tax nexus in West Virginia. So we will pause. Oh, no, I want to finish up to 25 here just because I think this is a good starting point for the next lecture. We're only at like 30 minutes here. So then the question becomes, right, entities included on the income tax return. When a business operates in as more than one legal entity, the way it files its taxes becomes an issue. Some states require a separate tax return for each entity with income tax filing requirements, where other states require a unitary return, one return for a group of related entities. What does this mean, right? So we always talk about businesses like, C Corp, right? Like it's a single business. That doesn't often reflect the actual legal structure of it, right? You may have something like a C Corp, right? And it's divided into its legal structure, all of these subsidiaries, right? Or other corporations, right? The question becomes, right, how do you tax this? Some states take the approach, right, that we're going to tax only in each kind of subsidiary, corporation underneath the corporation to the extent they participate in the state, right? That would be a separate tax return for each entity with income tax filing requirements in the state. Other states take the approach, right, we're going to essentially tax the whole group here, right? A unitary tax return on there. A couple other things, right? So if we're talking about, we're going back with separate return states, right? Only those businesses with an income tax filing requirement in the state are required to file. This is true even when a group of companies files a single federal consolidated return with other companies. So what does that mean, right? On the Fed, right, you would do a consolidated return, right, on the 1120 for that entire shooting match, right, consolidated. If then, right, you had a state, right, like let's just say California. California says, hey, I know on the federal return you tax that entire thing, but we're taking a separate return approach that says, hey, you have these subsidiaries. Which of them have economic income tax nexus? This one, that one. We're going to have you file a separate return for each of those here, right, in California. That's what this guy is saying. So separate returns allow for income to be shifted through related party transactions. Thus, states have been shifting away from separate returns. And thus, separate return states tax the entire apportioned income of each separate business unit with an income tax filing requirement. Right, so what's going on here? Let's look at 23.9, 23.10 to kind of catch us up. So business is domiciled in Idaho. Likewise, it has physical presence employees who exceed the protection in the following states. So it has sales in the following states. Where's the nexus here, right? So you can see you can establish it through domicile, physical presence, or you meet and you have sufficient minimum contacts. 23.10. Okay, so a business has income tax nexus in Tennessee because it employs and provides services in that state and it owns property. Must the business file a Tennessee income tax return? Well, yes, because it has income tax nexus and it's not protected by PL 86272. Now, right here, we're kind of catching us up to the stand. It says, assume a business splits into two corporations, right? So let's just say we have corporation one, which runs a retail store, and we have corporation two that provides services. How does the split affect the Tennessee return filing requirements, right? So Tennessee, right there. Let's say we're an out-of-state business, right? We're in state X, right? How does this work, right? And assume Tennessee is a separate return state. Well, the idea with this is C1, right? They're going to file a Tennessee return. And essentially here they file a return for their retail. And let's say that they're not protected by 86272 because they have solicitation that's not protected, right? So there we go. C2 is also going to file a Tennessee return because they're providing services, right? So what's the upshot of this, right? We have a business, right? For the Fed return, they're going to file a consolidated return for all of those. For the state, right, if Tennessee is a separate state, to the extent, right, each of the corporations have nexus, they have to file their own returns there. So here there would be two state level returns. So we said here that this idea of state level returns, separate returns, states are moving away from it, right? They're kind of going from separate returns to a unitary return. And what was happening, right? So if we have that kind of C Corp here that has all of the subsidiaries to it, right? So let's say you have like 1, 2, 3, 4, right? If let's say, we had Tennessee per that example, and 1 and 2 had economic income tax nexus, we know there's two returns there, right? 3 and 4, you wouldn't have to file a Tennessee return. What was going on, right? If we go back to here is, this kind of configuration allows for related party transactions, right? And essentially what would happen here is these companies, right, the ones that have income tax nexus, could kind of shift some of their income out of Tennessee or get expenses and things like that, which would make their Tennessee sales tax base go down. They pay less tax. So now what kind of states are doing is they're saying, look, right? We're going to file and move away from this separate return. We're going to move to a unitary return state, right? This is whether a business files one tax return with other business or entities depends on whether these businesses are a unitary group. So in other words, we look at the businesses here, 1, 2, 3, 4, and we say, are they considered a unitary group? Um, all members of the unitary group must be included. So let's just say, hey, all of these guys are a unitary group. We're going to include them. This kind of kills this idea of related party transactions because everybody's there. Um, and then they're going to file the return, as a single return from that unitary group. Now, one thing to be aware of here is there is something called a water's edge election. The idea here becomes, all right, so however, to provide help to businesses with foreign affiliates, imagine that these other subsidiaries, 3 and 4, imagine that they were in, like, I don't know, let's just say one was in Mexico and one was in France, right? The water's edge election says this, right? Whenever you are creating this unitary group, you're trying to box in all of the subsidiaries that are part of the unitary group. You can only do that to the extent they are in the US. In other words, the Mexico and the France one, right, they cannot be part of the unitary group for state income tax election. It's called water's edge, right? The reason for that is if you think about like the water, right, if this box was the United States, right, you only get the ones that are within, the United States as part of the unitary group there. Okay, so to summarize, what were we talking about? Uh, State income tax. Some states have separate returns, right? To the extent the business has kind of separate entities, each files its own returns. We said, right? So it's like separate. It's like shampoo versus conditioner, right? But we said that they're moving towards like a unitary standard, right? Where it's like 2 in 1, right? We're going to get, all members of that unitary group on a single return to avoid these related party transactions. But when we do that, most states have a water's edge election. How do we tell, right? One of the things here, so if we have all of these kind of subsidiaries, 1, 2, 3, how do we tell if they are a unitary group? Well, essentially, we look at these factors. Is there functional integration? Is there centralization of management? And is there autonomies or economies of scale here? Right? Most of the time, there is on these guys. So let's look at 2311 here, and then we can kind of wrap this up. All right, so we have a business that's divided into retail and services. The service company buys its equipment from the retail business, right? So we have, it's basically broken between retail and services, right? One thing they're telling us is retail sells stuff to the services division. Employees of the service company visit the retail business for trips so customers can purchase necessary service equipment. Both businesses use the same marketing and accounting firm. They get discounts for having multiple bank accounts. Are they considered a unitary group? Right? Well, the idea with this is yes, they are going to be a unitary group. They will file a single return in a given state that is a unitary state. And the reason for this, right, there is functional integration, right? They're working together, they're showing these kind of things going on. There's centralization of management, right? There's probably a board of directors or people who are running this kind of show between these two businesses. And there's economies of scale, right? Because they're kind of bigger, they're working together, they're getting discounts, right? For having multiple bank accounts, they're benefiting from being bigger. Okay, so with that, I'm going to end the lecture here for the first part of chapter 23.